want a slice. Got to roll the dice, that's why all my life I've been grinding all my life. Look, all my life, been grinding all my life. Sacrifice, hustle paid the price. Want a slice. Got to roll the dice, that's why all my life I've been grinding all my life.
Hey everyone, how's it going? Tuesday, here we are. We got some news to cover, got some things to tell you. I think I got my audio playing through my phone here. Just let me try to turn this down. Not sure why that's coming through. Maybe I can mute it over here. No. Oh well, should be right. So yeah, I've got a few topics to get through. ASX news, share price, dilution, and the US watch list. So starting out, some ASX news. Afterpay today broke $50. So if you've been someone that's been following Afterpay for a while, you would have seen that it fell to nearly $8 during the COVID crash at its worst. So we've had a massive bounce back on that share price. Just let me know if that audio from my phone is coming through too badly, guys. Let me know, and if it is, I'll try to fix it up. But yeah, the share price bounced back over $50 today. I think it actually closed below $50, pulled back a little bit once hitting that all-time high. Yeah, so it closed the day at $49.11. But yeah, the big news behind Afterpay is that it's been put into the Australian MSCI index, MSCI index, I think you refer to it as. And yeah, I mean, there's been some good news that has come out of it. Tencent taking an equity stake in Afterpay has really bolstered the company and pushed the share price up. And so it's cracked above 50. It'll be interesting to see how it goes now, though. I did read an article, I think it was from Bell Potter, that typically once a stock does get into the MSCI index, it will fall after the rally, because you do have fund managers that will have to actually buy the stock to enable to actually include it into their passive portfolios that they manage for their investors. So those fund managers will have to go buy Afterpay shares in order to put it into their portfolio. And once they do that, after they've finished doing that, which will push the price up, we'll probably see the price begin to fall back down a little bit. And also, if history repeats itself, at the end of last financial year, and this typically you see this across most of the stock market, once you're nearing towards the end of the financial year, people will sell stocks just to crystallize their profit or losses for tax purposes mostly. And by doing that, if you've got a lot of people wanting to get out of a stock, to do that, people selling, the price is going to fall. So if history repeats itself, we'll probably see Afterpay shares fall leading up into that. But we'll keep an eye on it and we'll see how it goes. Other ASX news, we've got Raise Invest. Now, anyone who uses the Raise platform, which is a way of investing more for beginners, but I use Raise and I'm fairly familiar with investing myself these days, and it's a good platform. So it's a good way of diversifying your portfolio. So I use it. I have some money in it. They've actually announced a portfolio that includes Bitcoin. So this portfolio, and I was going to log into my actual Raise account and show you this, but I wasn't actually able to log in for some reason. But they've allocated 5% of, it's basically like a moderately aggressive portfolio, and your US large cap, your ASX large cap, your Asia large cap, Europe large cap, but they've and bonds as well, but they've then allocated 5% of Bitcoin into that portfolio. So it's really interesting. I think that Raise is actually one of the first to actually offer some sort of investment product with a cryptocurrency included in it. So it's pretty cool. It's pretty interesting, and it'll be cool to see how Raise actually goes with that, if they see an uptake in funds under management, as people looking more towards cryptocurrency as a legitimate form of investment and a store of value at minimum. If Raise is one of the only or few people on the market that offer such a product, then surely they'll see some sort of inflow because of that. Just a quick question from Josh. Thoughts on investing in Raise? Yeah, I've looked at it a couple of times. I'm not too sure. I'm not 100% sold on the company as an investment myself. I think the funds under management that they currently have isn't substantial enough for me to want to go invest in Raise itself, invest in the company. But I will definitely be keeping it on my radar as the company grows. It has really good growth. I think 20% plus year over year growth in the funds under management that it has. It's launched its super product, so you can directly manage your super investments through the Raise Super, and recently they've actually branched out into insurance, and they've offered some different insurance products through its platform. So I sort of see it similar to Kogan in the way that it's got its staple business, but it's starting to branch out into the other financial businesses. And I think that might work well for Raise. Insurance and that can be a bit more profitable than their fund management business alone. But at the moment, I haven't looked too greatly into it as a serious investment, just because of the size of the company. Mostly, I would like to see it get a little bit bigger with more funds under management before I went and invested in the company itself. I don't think it's profitable. Correct me if I'm wrong, but I don't think Raise is profitable. Yeah, I could be wrong with that. But those smaller companies that having a cap raise and they're not making a profit, I tend to not want to put too much money in them. I might have one or two investments like that, but it's not something that I'll look to as a large number of my holdings being companies like that. I think Raise is a good business, but it's just at the early stages of it. And with the bundle integration from FlexiGroup, I think that will really they'll leverage that to onboard even more customers. So I think it will definitely continue to grow, but I would like to wait to see that growth before I go actually investing in Raise. But that's just my opinion on it. There's plenty fors and againsts on it, and I'm not saying not to invest in it. But yeah, my personal opinion is I just like to see it get a little bit bigger before I go put money into a company like that. So yeah, Raise, it's got that 5% Bitcoin allocation to its new Sapphire portfolio. If you want to check out Raise, if you're interested, you're a beginner investor, you want to get into investing in a small way, go check out Raise. It's a really good way to start investing. I've got a referral link in the description of this video. If you sign up using that, you'll actually get $5 for free just by using Raise and using that referral code. So if you are interested, use that out. It helps me out. It'll help you out. Yeah. So another bit of news from Downer. They've expanded their Fortescue relationship with a $450 million contract. So this news came out today. It is expanding its relationship with Fortescue Metals through the provision of early mining and maintenance services at Eliwana Iron Ore Mine, located in the Pilbara region of Western Australia. So Downer, I think, has been getting pretty hammered, with... I think they actually settled a lawsuit recently or something like that. But yeah, the share price has been pretty hammered, down from $8.88 to a low of $2.73. We're back up at $4.56. This is a bit of good news out of the company, though. Continuing to solidify a relationship with Fortescue Metals Group, which Fortescue Metals Group has absolutely been killing it. It's continuing to make new highs with their share price due to iron ore prices continuing to just skyrocket. So this is a good contract win for Downer. Definitely to be taken in consideration if you're looking at Downer as a company to invest in. So this new agreement is valued at $450 million over 5 years. Under the agreement, Downer will complete early works operations over 2 years as the mine site is established. After this initial 2-year term, the operations will transition to Fortescue's autonomous mining fleets. Downer will remain at the mine site and provide maintenance services for a further 3 years. So a good bit of news out of Downer. If you're someone who owns shares in Downer or looking at it, that's definitely worth knowing that this contract exists and that they've got a $450 million contract, and share price rallied on it, of course, up 6.7%, nearly 6.8%. So it's some really good news. I thought I'd share that, and that's probably the main bits of news out of the ASX today. It wasn't anything too massive. It was another good day on the market. Ended the day up 2.9%, so really good. We actually exited the bear market due to the rally that we've seen. We're now out of the bear market, so it's a pretty pivotal point in the market. At this level, I think will be the decider over the next 2 or 3 weeks, probably, whether we continue to push higher or whether we reverse and start to make our way back to testing the lows that we saw during the peak of the coronavirus crash. But yeah, good day on the market today. Hope everyone's portfolios did well. Mine didn't do the best, but I know a lot of others that did do really well, so that's what we want to see. So moving on from that news, I did want to discuss a little bit, just speaking about Australian shares while we're on the topic. Hello World Travel Group, they absolutely skyrocketed today. I mean, they killed it, up 32.7%, and this is on already a massive rally on the shares. They were below a dollar at one point, and now they're up above $2. And I just wanted to take the time tonight to sort of discuss something on this. I think a lot of early investors may not realize what I'm about to tell you with stocks like Hello World and even Kathmandu, which is my largest holding in my portfolio at the moment. So the thing that I want to discuss is dilution. So I think a lot of early investors, and I myself, when I first started out, I knew nothing about it. It probably took me a good year and a half before I ever, even heard of dilution, let alone understanding what dilution to the share price actually, or dilution to your holdings is. So if we're to take Hello World Travel, the current share price is at $2.19, right? And we've seen a massive rally, and you may look at this graph and think, well, it was at $5 before the COVID-19 crash, and it's at $2.19. It's up 33% today. Now might be a good time to pick up some shares in Hello World and ride the rally back up to $5. That could be the case, but what you have to understand is that Hello World will unlikely hit $5 for quite a long time. And the reason for that is that with capital raising, which Hello World has done, because the interruption on revenues due to the situation that we have, when you capital raise, you issue new shares, and when you issue new shares, you're affecting the market capitalization and thereby affecting the share price. So your market capitalization is just a function of your number of shares issued multiplied by the share price. And that's your market capitalization, the full value of the company. If you're going to issue new shares and say, this isn't the fact, but if we look at Hello World, I don't know the exact numbers, but let's just do a hypothetical here. It says here shares outstanding nearly 125 million. Okay, and you multiply that by say $2, and you get your market cap roughly. So, but if they had to do a cap raise, their number of shares may have been, who knows, maybe half of that. I don't know for sure, but just hypothetical. So let's say 60 million, and you issue new shares, so double what their previously was. That means that in order to have the same market cap, your share price would be half of what it previously was, right? So if the share price was to go back to $5, then effectively the market cap is double what it was before the crash. So you have to understand the dilution factor when new shares are issued and what sort of effect that imposes on the share price potential. It'd be pretty unreasonable to say that within 6 months the share price could be back to $5. And you could say that with a company that didn't have to capital raise and didn't have to issue new shares, because by it going to the previous, the share price that it was at previously before the crash, it would still be at the market cap that it was at before the crash as well. So the company would be valued at what it was before the crash in the share price. But for a company that has issued new shares, if it goes back to that level, it's actually going to be valued at more. The total market capitalization of the company is going to be worth more than what it was prior to the crash. So you have to understand that fact when you're talking about companies that have done capital raises. You want to go have a look at the press releases of the company, the announcements, and nearly pretty much for any investment that you're going to do at the moment, because so many companies have actually capital raised. You want to go have a look and see if the company has performed a capital raise, and if so, how many shares did they issue? How many new shares? In order to understand your dilution factor. So for me, with Kathmandu, they issued 140%. So the number of shares was, I think it was like 250 million previous before the cap raise, and now they're at nearly 700 million or so. And by looking at that, and if we have a quick look at Kathmandu, you can't fall into the trap of looking at this graph and seeing that before the crash it was nearly $2.50. You can't go buy Kathmandu shares right now just under $1 and expect that in 6 to 12 months' time it'd be back at $2.50, because the equivalent price, and if you're looking at the market capitalization, the equivalent price due to dilution is much lower. I can't do the calculations right now quick math, but it's much lower. So your cap has been heavily reduced, and I think it actually works out to be that at about $1 or $1.10 or so is the equivalent of no, I think it's about $1 is the equivalent of the Kathmandu share price being at about $2.30 prior to capital raising. So that's how you have to think about it, because if you're going to be buying shares in Kathmandu today, you have to realize that effectively, if you're looking at the peak before capital raising, you're effectively buying it at $2.33 if you factor in the dilution, okay? So I thought I'd just share that because, I see this huge run up in Hello World today, and I start to think, how many people buying into Hello World today actually went and read these announcements? Actually went and read Hello World Travel sees cash losses of $1.5 to $2 million per month for the next 6 months. And not only that, but they expect break-even position in Q2 of full year 2021 and small profit in the second half of full year 2021. How many people actually went and read that? And not only that, how many people then went and delved into the trading update and broke down the full list of what the company is expecting for the future? And not only that, how many people then went on to read the capital raising that Hello World did and the effect of that dilution on the share price? What if they issued 3 shares for every one at the bottom of this crash? And that means then probably at this price it's overvalued. It's probably already beyond the previous peak. I'm not saying that's the case, but what if you bought into the company not having any clue on what the capital raising was? So I'm just putting it out there as particularly for people that are new into investing, and I know there's a lot of people, particularly in Australia at the moment, that have just gotten into investing. I saw it on the news, the search, if you look at Google Trends, the search term for how to buy shares in Australia or whatever is skyrocketing, like it's up 300%. So for all those people that are trying to get in on dirt cheap stocks at the moment, please have a look at the company, read into if they've performed a capital raise and what sort of dilution that has had on the share price, because you cannot look at this graph and think that the share price will go back to $5, because it's not the same. It's not the same anymore. If it goes back to that price, then the company will be valued more than what it was when it was at that price previously, because now you have more shares, okay? So just keep that in mind, because I don't want new investors getting burnt from jumping in on a stock that's rallying up and thinking there's another, that they can still double their money because, they're down here at $2 and, $5 is the ceiling, okay? So just keep that in mind. Just a question from Mitchell. What do you think of Flight Centre? Honestly, I don't really like the business. If I was looking at any travel stocks, and I was having a chat today about this, if I was looking at any travel stocks, I would my preference would probably be something like Webjet, just because I think they really do the online system well. And they've got good growth potential in their business, particularly with web beds, which is like the room booking, accommodation attached onto the Webjet platform. Whereas Flight Centre is very much, to me, it's like an old school way of doing things. It's an old business model, physical storefronts, and we can see that. That's why the CEO closed so many stores. They realized that that's where most of their expenses are, and they need to cut back on that. But I still think even moving forward, it's going to be an issue. It's a business that relies on physical storefronts and getting people walking in through the door. And not only that, I tend to think that there's too much expenditure on the staff, trying to educate their staff with sending them overseas all the time and doing work trips. And, there's some value to that, and I can understand that. But I think the return on investment for Flight Centre itself by doing that is not great. And I think the business needs a proper restructure and a replanning of how it's going to operate moving forward if it's going to really pull out of this better than what it was before. So myself, I don't really like Flight Centre as an investment, just because of the business model. I mean, it could be a sound investment. It seems to be fairly valued at, PE of 4.5, but also this number isn't always telling. You have to look into it a bit more, because sometimes the PE ratios are a bit out of date. But yeah, I think Flight Centre's probably got a long road ahead of it before it really starts to get back up on its feet. And if it is a business that I was seriously looking at, I'd probably be happy to miss out on the next 6 to 12 months and miss out on maybe 50 to 100% returns by not jumping on this stock, just in order to get it at a better risk to reward ratio. I think at the moment it's the reward isn't there. Like, it's just not the ratio just isn't in the positive favor. So, and as always, like, this is just my opinion, and I'm not a certified financial planner or a financial analyst or anything. But that's just my 2 cents. I tend to steer away from companies that have more of an older business model. I like businesses that are moving more towards the future, and that's why a lot of my holdings are more tech-related stocks, because I think inevitably the businesses have to move that direction, and the businesses that are doing it now are going to be years ahead when eventually they do have to switch over. They do have to migrate and join what becomes the norm. So yeah, me personally, I'm not a huge fan of Flight Centre, but I know plenty of people that do like the stock. But you have to remember that it was pretty much on the verge of collapse only like a month or two ago. So I think it's very early days, and there's nothing wrong with waiting out on a stock, not trying to get it. You could try to capture it now, and it could maybe bounce up to $20, $25. And the same case here. It probably won't hit $40 for a long time because of dilution. But you could get in on it and think, it might run to $20, $25. But, I'd be happy to miss out on that potential for it to drop back down. That's just what I think about it anyway. Yeah, definitely, like, it will be interesting to see what happens with all the travel stocks and airlines as well, how quickly they'll bounce back once those restrictions are lifted. And, I think there'll be a lot of people that do want to travel. There are a lot of people that will have just absolutely hated the last 3 months being, locked up, not able to go on a trip somewhere. People that want to just get away from all the stress that we've been enduring. But I also think there'll be a lot of people that will somewhat be stuck in the pattern of taking extra precaution. There'll be people that are still quite concerned about the whole scenario. So it will be interesting to see how that pans out, because I don't think anyone can really predict how people will bounce back once the restrictions have lifted. But anyway, guys, I think I hope that was insightful, talking about the dilution, because I think there's a lot of people out there that look at these stocks, and Flight Centre is another prime example where there's dilution. You see announcements like completion of retail entitlement offer. Look into that. If they've an offer or an institutional offer, they've probably created new shares and diluted the share price. So look into it before you go jump in and investing in any of these companies, and do it for any stock at the moment, because a lot of companies have been capital raising. So it's worth understanding what you're getting for your money. So moving on from that, guys, I think I might go through my watch list for the US stocks. So I'll just drag this open. So yes, my watch list for the US. The market was closed last night, Monday, because of Memorial Day. So the US doesn't trade on Memorial Day; it's a public holiday. Jacob Stevens, Sol Patterson and Co. Limited, thoughts. It's not a stock that I've actually followed too much. I looked at it a long time ago, probably when I first got into investing, and considered, putting a little bit of money in it. My understanding is it's quite a, let's have a look. It's in the financial markets, I believe. Is this the one we're talking about? Sol? Washington Sol Patterson Company, listed on the ASX. Investment house with investments in a diverse portfolio of assets. Yeah, coal mining, gold, copper mining, refining, property investment, and consulting. Yeah, so I'll have to be honest. I haven't actually been across this stock too much. It hasn't been on my radar for a very long time. But if I was to have a quick look at it, and it's probably not great to listen to my opinion on this one because I'm not, aware of it too greatly. Like, I haven't been across it much. PE ratio 12.7. It depends on whether they've done capital raising. I don't particularly like to offer my opinion too much on a stock that I haven't been across, because there's so many things that can come into play on a stock. And that's why I always do like a deep dive on stocks before I go offering my opinion on them. Typically, 3.1% dividend yield, that's pretty decent if you're looking at it for a dividend play. Then also you should look at whether they've suspended dividends during the COVID-19 downturn. But I mean, if it's a business that owns investments in coal mining, gold and copper mining, property as well, and consulting, that's a pretty diversified portfolio of investments that they have themselves. And that probably gives them some flexibility within their dividend, gives them some level of risk management. If some assets are underperforming, others may be holding up quite well. I'd imagine coal's probably doing not too badly. Gold's doing really well. Gold's been rallying due to, numerous factors. One being, the economy's been pumped full of new money, which is devaluing currencies. So people turning towards gold as, a safe haven for value in their money, rather than a currency that's been devalued. There's other reasons behind gold, but gold always tends to do well during uncertain economic times. People look to it as a safe haven, so it's been performing well. I'm not too sure about copper. Property is a bit of an iffy one. I think property is probably going to fall a bit. But I mean, I think this company is pretty well diversified, and it depends on whether you're looking at it from a short-term or a long-term perspective. If you're looking at it for a long-term hold, I think they're a pretty good company. Like I've only heard good things about them as from a long-term standpoint. A good dividend, normally fair value. You know, doesn't look reasonably overvalued. And if it hasn't performed a capital raise, then you're catching it at a pretty good discounted price, below $20 if it was nearly at $30 previously. Now that's dependent on the fact, you know, whether they have done a capital raise or not, and I don't know that. You'd have to look into that. But yeah, I mean, just from a high level perspective, if they haven't done a capital raise and they haven't suspended their dividend, looks like a pretty solid play. That's just from a high level perspective anyway. Hopefully that helps. You know, I don't know a hell of a lot about the company, so I can't offer too much, but that's just a high level overview. So just jumping back onto the US watch list. So the ones for tonight, we've got, and this is, I've actually got this incorrect, Enaplan, which I've got reporting after close, is actually before open as well. So we've got AutoZone and Enaplan, or Anaplan, however you pronounce it, before open, and we've got Keysight Technologies reporting after close. So I'm long on AutoZone and Enaplan, and short Keysight Technologies. Now I'll go into depth a little bit as to why I have those sentiments on those stocks. So starting out with AutoZone. Now the auto industry has, and we had Advanced Auto Parts actually report last week, and they performed really well. I was long on that stock, and I think they did a double beat, or it was at least a one beat on either earnings or revenue, and the stock rallied. I think AutoZone will be much the same. You know, it's a bit of a like for like on the industry plays. You know, there's less, and well, the US is different, but just talking from Australia, there's less general public driving on the road, but there's still plenty of transport, you know, for goods that are occurring. And I think in the US, it's probably more so. I think in the US, there's been less of a lockdown, so there'll be more of the general public still driving, more businesses still operating with the use of vehicles. So the need for their services will have still existed, still have been there. And yeah, it's a business that continues to operate during the lockdowns. In the US, honestly, I don't know if they've had too much of a lockdown. It's more of a please stay at home. And there's still people that aren't really doing that. But yeah, I think AutoZone will operate fairly reasonably. And even online, if we just take a quick look at their online presence. So year over year traffic has fallen 14.17%, but month over month is just a decrease of 4.4%. So there's not that much of a decrease really. And I think the share price, if we look at AutoZone share price, it's at 1,122 as opposed to its high at 1,229. So I think AutoZone has the potential to surprise with a beat. I think their service has still been used, their products have been purchased. So I'm expecting that they'll report pretty decent numbers. The next one, Enaplan, which is reporting before open, not after close, before open. Enaplan is really quite an interesting company, and I didn't know about them prior to this. I actually looked into them a little bit when I was doing my watch list this weekend. But they I'm just reading from their little bio here, continuously optimize business performance using Anaplan, connected planning, forecasting, scenario management, and real-time enterprise-wide line of sight. And this is a play on people working from home. For me, I think that their business will have done well because of more companies being forced to work from home, being not having that in the office interaction. This is a business that has largely done most of their servicing towards companies that you have a corporate office, but you need to deal with financials across other offices as well. So you might need to work with the head of finance in Brisbane, as well as Melbourne, as well as Perth and Cairns, and you've got your corporate office somewhere else. This platform is really well geared towards that. But, during the situation that we've had, this is very much a platform that could be utilized within a single office even. Say you have 2 or 3 people that work in the finance department or statistical analysis or anything like that, that need to continue to work together. This platform could very well much be geared, or you could take this platform and use it for that very use case. So I think that they will have performed quite well, given the nature of their product, and also they just have some really big names as customers. So I think you got to take them pretty seriously. And the sort of customers that they have, mostly companies that probably haven't been too affected by the shutdowns, companies that have still continued to operate at the same level or close to, and not companies that may have been looking at drastically cutting cost and possibly have cut their service to a platform such as Anaplan. Most of their customers, I believe, would be businesses that wouldn't have had to have done that, and so they would have retained them as a customer. And if we look at the share price of Anaplan, it's rallied pretty decently at $51, but it was at 63. So I think there might be a little bit left in the tank, maybe 50, 55, 56, 57, if it does report some good numbers. So that's what I'm sort of expecting to see out of that one. The last one is Keysight Technologies. They offer quite a broad range of products, from mobile-based metering systems to the physical metering devices and testing equipment, and that sort of thing. I was just going to try to find some products so here's a full product list, and it's very broad. They deal with a lot of products, and I've looked into this a little bit just before I started this video, looked into their prior quarterly reports, and I have to say I'm a little bit unsure on my sentiment now, to be honest. I did have them down as going short, but looking into their products listing and their previous quarter and what they were discussing, and we know that 5G has been rolled out and it's the next big innovation. They offer products for that, amongst a vast array of other things, from oscilloscopes, spectrum and analyzers, network analyzers, wireless network emulators, 5G base station test equipment. It's just a huge amount of stuff. I was short on this previously because I thought they were geared towards test equipment that you'd typically see like within universities, education based, but I realize that they do much more than that. So there's two ways this could go. The first being that the COVID-19 situation has interrupted the rollout of 5G manufacturing, equipment from this company, and they did state that in their forward-looking statements. So they said the temporary closures impact both the company headquarters in California and principal order fulfillment and manufacturing operations in Malaysia. These actions may impact the company's ability to meet the fiscal 24th, 2020. So they're saying that due to the situation that their manufacturing may have been interrupted. And if that is the case, then I think they will fall a fair bit. But they may have bounced back with their manufacturing, or they may have found workarounds, other places to do it. I'm a bit unsure, but I will hold my short sentiment on this one. Just usually my first gut feel is right, but I'm a little bit less. This isn't a high probability play. If I was to make a trade on this, I'd feel very uncomfortable because I haven't got solid evidence on this one, or I'm not even convinced in myself. So I'm a little bit uncertain on this one, but I'll still hold the short sentiment, and we'll see how that one goes. But yeah, guys, I'll probably finish it up on that. I think that's probably enough for tonight. If you are interested in the rest of my US watch list, check it out on Twitter or Instagram. I posted it on there as well. And also, I will be making some Market Unpacked shirts pretty soon. So if you're interested in repping some Market Unpacked merchandise, drop a comment and let me know, and I'll do you a good deal. So I'm hoping to have that in the next week or two. And people that have joined the private Discord group, I'll be doing a good deal on that one, doing a good deal on the t-shirts to anyone in the private Discord group. The people in there are really supportive of the channel, and we really enjoy the chats that we have in the private Discord. So if you're not in that already, there's a link in the description as well to join the private Discord and get amongst that. So other than that, guys, I think that's about it. Thanks for tagging along on your Tuesday night and sticking around, and you'll catch me in the next video, which will probably be Thursday. So between now and then, enjoy investing, enjoy trading, make sure you play it safe, look at dilution, and go make some money. Cheers, guys. Bye.